Inside every huge corporation, there's a kind of financial magic trick happening constantly. It's a puzzle that, if they get it wrong, could make the entire company look healthier or sicker than it really is. So we're going to pull back the curtain and see exactly how it's done. So just think about this for a second. If one division of a company sells something to another division, how does the head office report its finances without getting totally tied in knots? That is the fundamental problem we're going to untangle right now. All right, the best way to get your head around this is to picture a giant company as a corporate family. All its different divisions and subsidiaries, they're like siblings. They're always selling stuff to each other, lending each other money, you name it. It is one very busy household, financially speaking. Okay, so with all this internal chaos, how does the parent company keep things straight and not count the same dollar over and over? Well, they don't just cross their fingers and hope for the best. Nope, there's a specific rulebook, a playbook, designed to bring order to the whole family. And that rulebook has a name, Intercompany Accounting, or ICA for short. It's the official process for tracking all those transactions between the siblings, making sure all their stories line up, and then making them disappear when it's time to show the family's total wealth to the outside world. See? This is all about perspective. For the individual siblings, that transaction is 100% real. Company A definitely made a sale. Company B absolutely has a new expense. But for the parent company, looking down at the whole family, it was just money moving from one pocket to another. No new cash came into the family, so that transaction has to, vanish from the final report card. So why do they go to all this trouble? Well, the reasons are absolutely critical. It's all about making sure the numbers are right, following big-time accounting rules like IFRS and GAAP, and, this is the big one, getting rid of any fake internal profits. At the end of the day, it's about being honest and not tricking investors into thinking you're doing better than you actually are. So how does this vanishing act really play out? Let's follow the money. We're going to trace a single transaction all the way from the moment it happens to its final disappearing act. This whole journey really has three main stops. First, you've got the sale, where each company writes it down in their own books. Second is reconciliation, where they get together and make sure their stories actually match. And third, the final step, is the elimination, where the parent company makes that whole internal deal disappear from the group's official report. Let's make this real. So Company A sells something. On their books, they record two things. Hey, we made some revenue, and now Company B owes us money. That owed money is an asset we call Accounts Receivable. Now, over at Company B, the buyer, they're also recording two things. Awesome, we got new stuff for our inventory, but also, shoot, now we owe Company A money. That debt is a liability called Accounts Payable. So at this stage, each sibling has their own version of the truth, and both are correct. Okay, step 2. This is the reality check. It's called reconciliation. The goal sounds so simple. The money the seller thinks they're owed has to perfectly match what the buyer thinks they owe. But, in the real world, this is where things get messy. One team might record it on a Friday, the other on a Monday. The currency rates could have changed overnight. Or, honestly, someone just typed in the wrong number. All of this stuff creates mismatches that have to be fixed. And now for the grand finale. Once everything is reconciled and balanced, we get to the elimination. The parent company steps in, and for its big picture report, it just cancels everything out. Company A's internal revenue gets wiped, and Company B's internal expense gets wiped. Poof, the transaction is gone. This is how they make absolutely sure that they're only reporting deals with the outside world. Now, in theory, this process is pretty logical, but just try to imagine doing this for thousands of transactions every single day across dozens of different countries. Yeah, that's where the neat theory crashes into some very, very difficult real-world hurdles. I mean, the complexity comes at you from all sides. You have a crazy high volume of transactions. A lot of it is still done manually in spreadsheets, which, let's be honest, is a total nightmare. Then you throw in currencies that change value by the minute, complicated tax rules, and sometimes just plain old arguments between divisions. The whole thing can spiral out of control really fast. But, of course, this is the 21st century. You don't fight this kind of complexity with more spreadsheets. You fight it with smart technology. Companies are finally moving away from all that manual grunt work and are embracing automation to get the job done. And the difference is just night and day. The old way literally meant finance teams were drowning in spreadsheets. It was slow, it was packed with errors, and it just sucked up so much time and energy. The modern way, you've got automated systems that can match thousands of transactions in a blink. flag any problems immediately, and give everyone a crystal clear dashboard to see what's going on. We're talking about really powerful software here. The big ERPs like SAP and Oracle have this stuff built in, and then you have specialized tools like Blackline that focus just on this. They automate the matching, they give you dashboards to see everything at once, and they even help manage disputes with a proper workflow. For finance teams, it's a total game changer. But, and this is so important, you can't just buy fancy software and expect magic to happen. Technology is only part of the answer. The really successful companies combine these amazing tools with rock-solid practices. They make sure everyone's following the same process, they create clear agreements between all the siblings, and they define exactly who is responsible for what. It's about building a whole system, not just buying a tool. So this all brings us to one last big thought. As these corporate families get more and more global, more complex than ever before, this whole challenge just gets bigger. And it leaves us with a really interesting question. In today's world, is perfect, flawless financial transparency actually an achievable goal? Or is it more like a horizon you're always chasing? A constant, never-ending pursuit of accuracy in a world that just keeps changing?